You're sitting at your kitchen table on a Sunday afternoon, calculator open on your laptop, Zillow in another tab, and you've just done the math that breaks you. $500,000 for a basic three-bedroom house in a decent school district. 20% down. That's $100,000. You open your savings account in another tab. $12,000. You've been saving aggressively for 3 years. The house you were looking at 3 years ago, it was $380,000. You needed $76,000 then. Now you need $100,000. You saved $40,000 over 3 years and the finish line moved $76,000 further away. You're running backwards. Sound familiar? That moment when you realize you're not failing to save. You're losing a race that's rigged. Everyone tells you to just save 20% like it's a character issue. Like people who don't have six figures sitting in cash simply aren't disciplined enough. Meanwhile, the median retirement account for Americans at age 40 contains less than the down payment on a median-priced home. This isn't about you. This is about a system designed to keep you trapped between renting forever and buying with PMI extracting maximum wealth from you either way. I'm going to show you the complete mathematics of why the down payment requirement has become an impossible barrier. I'm going to expose exactly who profits from keeping you in this trap. And I'm going to reveal why both paths, renting and buying, are designed to transfer your wealth to someone else over decades. But here's where it gets interesting. The real question isn't whether you can afford a house. It's how the down payment requirement transformed from a reasonable savings goal into a mathematical impossibility that functions as permanent gatekeeping for an entire generation. Let me show you the numbers everyone avoids. To save $100,000 in 10 years requires $833 per month. That's the simple version. Put away $833 every single month for a decade, and you hit your target. But here's where it gets mathematically impossible. I just showed you need to save $833 per month for 10 years, but that assumes something that has never happened in American housing history. Prices freezing completely. Look at historical appreciation rates. 6% annually is the average over the past 20 years. Seems reasonable, right? Now watch what happens to your math. That $500,000 house today becomes $895,000 in 10 years at 6% appreciation. Your down payment target just became $179,000. You're not saving for a stationary goal. You're chasing a target that's accelerating away from you. Calculate what you'd actually need to save. To hit a moving target appreciating at 6%, you need to save $1,493 per month. Not $833, $1,493. Every single month for 10 years, without missing once. Let's put that in context. Median household income in America is $75,000. After federal taxes, state taxes, Social Security, and Medicare, that's roughly $55,000 take home. $1,493 per month is 33% of your after-tax income. You're being told to save one-third of your after-tax income for a decade, not for retirement, not for emergencies, not for life itself, just for the privilege of entering the housing market. And that's forgoing retirement contributions that would get employer match. That's forgoing the emergency fund every financial advisor says you need. That's forgoing career development, health, relationships, everything that makes you human, all to chase a number that's running away from you at 6% annually. Here's what nobody tells you. While you're saving that $1,493 per month, you're still paying rent. The median rent in America is around $1,900, so your actual cash outflow is $3,393 per month before you eat, before you drive, before you exist. On $55,000 take home, that's 74% gone before groceries. The math doesn't work, it cannot work, it will not work. So maybe you're thinking, forget the 20%, I'll just pay PMI and get in the game now. That's exactly what the industry wants you to think. Let me show you what that actually costs. On a $500,000 house with 3% down, that's $15,000. You're borrowing $485,000. At 7% interest over 30 years, you'll pay $1,293,490 total. That's nearly 1.3 million for a house listed at 500,000. But now add PMI. Private mortgage insurance typically runs 0.5% of the loan amount annually. On 485,000, that's $2,425 per year. $202 per month. And here's the brutal part. You'll pay that for an average of 7 years before you reach 20% equity and can drop it. 7 years times 2,425 equals $16,975. Call it $17,000 in pure waste. Money that vanishes. Money that builds zero equity. Money that protects the lender, not you. But that's not even the worst part. With only 3% down, you start underwater the moment you pay closing costs. Closing costs run 2 to 5% of purchase price. Let's say 3%. That's another $15,000. You put down $15,000. You paid $15,000 to close. You've spent $30,000 and you have $15,000 in equity. You're trapped. You can't sell without bringing cash to closing. You can't refinance without an appraisal showing enough equity to justify it. And you're locked into whatever interest rate you got on day one. This is the industry's preferred outcome. You're stuck in a high-rate loan paying penalty fees with no easy exit. They don't want you to have 20% down. They want you desperate enough to accept PMI because PMI is nearly pure profit. The insurance rarely pays out. Lenders collect premiums for years on millions of loans, pay claims on a tiny fraction, and pocket the difference. Your $202 per month isn't protecting you. It's profit. Let me show you what this looks like in real life. Meet Maria and David Chen. Combined household income, $95,000. That's above the national median. They're both college educated. They have stable jobs. They saved $25,000 for a down payment over 4 years of intense sacrifice. They bought a house for $480,000 with 5% down. They did everything right. They should be comfortable, right? Here's their complete monthly reality. Mortgage principal and interest, $2,550. PMI, $200. Property tax, $650. Homeowners insurance, $220. HOA fees, $180. Maintenance reserve, $400. Total housing cost, $4,200. Their after-tax income on $95,000 gross is roughly $5,900 per month. Subtract housing. They have $1,700 remaining for everything else. Now let's talk about everything else. Car payments, $520. Car insurance, $180. Gas, $200. Groceries, $800. Utilities, $280. Cell phones, $120. Added up, that's $2,100. Their remaining amount was $1,700. They're negative $400 per month before accounting for clothing, medical expenses, entertainment, or literally anything unexpected. And this is where the spreadsheet becomes real life. David brings lunch from home every single day, saves $12 daily. Maria cut her hair appointments from every 6 weeks to every 12 weeks, saves $60 per month. They haven't taken a vacation in 3 years. Their 6-year-old daughter asked why they never go out for ice cream anymore. That would be $8 they don't have. They reduced their 401k contributions to the minimum needed for employer match. They're losing $180,000 in retirement growth over 30 years by not maxing out those accounts. Here's what that actually feels like day to day. It feels like saying no to a $35 field trip because that's groceries. It feels like hoping your check engine light is a loose gas cap and not an $800 repair. It feels like your spouse suggesting pizza for dinner and you doing math in your head before answering. It feels like being house rich and life poor. And the math says they're actually losing wealth long term. The opportunity cost of that down payment, the lost retirement growth, the PMI waste, they're paying for the appearance of success while their actual financial future deteriorates. They're paying $202 per month in PMI, $2,424 annually, for insurance that only benefits the lender. That money could fund weekly ice cream trips with their daughter for the entire year. It could fund Maria's hair appointments. It could be the buffer that keeps them from running negative every month. Instead, it evaporates, and they're locked in for 7 years minimum. You want to know why everyone is telling you to buy right now, despite these numbers? Let me show you exactly who profits when you sign those papers. Real estate agents first. On a $500,000 sale, total commission is typically 5 to 6%. That's $25,000 to $30,000 split between buyer's agent and seller's agent. Their incentive is to get you into the most expensive house you'll possibly qualify for. Not the house you should buy, the house that maximizes their commission. They don't care if you're house poor in month 2. They got paid at closing, lenders second. They actually profit more from PMI loans than from 20% down loans. Think about it. On a $500,000 loan with PMI, they receive $2,400 plus annually in PMI premiums. Over 7 years, that's nearly $17,000 of pure profit beyond the interest they're already collecting. The insurance rarely pays claims. It's designed to protect them from loss, and you're paying for that protection. They have every incentive to approve you for a loan that requires PMI rather than encouraging you to save more. Mortgage insurance companies third. This is their entire business model. Collect premiums from millions of borrowers who couldn't meet 20% down. Pay out claims on the tiny fraction who default. The rest is profit. Your monthly $202 multiplied by millions of PMI payers generates billions in annual revenue. Yeah, the system needs a steady supply of people who can't quite reach 20% down, but can barely qualify for a loan with PMI. Builders and sellers fourth. They want prices high. The down payment requirement serves as a pressure valve. Keep it high enough that only those with generational wealth or too high incomes can meet it easily. This maintains exclusivity and justifies elevated prices. If everyone could suddenly afford 20% down tomorrow, demand would surge and they'd just raise prices further. The barrier is the point. And here's the psychological manipulation they've all normalized: the narrative that you're throwing money away on rent. This creates urgency and shame. It pressures you into buying before you're financially ready because waiting feels like losing. But let me show you the alternative math. Rent a comparable home for $2,500 per month. The Chen household would have $1,700 left after rent instead of negative $400 after ownership costs. Invest that $1,700 per month at 8% return. In 10 years, you have $294,000. The homeowner has equity, sure. But after deducting all interest paid, property taxes, maintenance, insurance, and PMI, their actual wealth accumulation is substantially less than $294,000. And the renter maintained emergency funds, maxed retirement accounts, and actually lived life instead of just surviving month to month. The rent is throwing money away, narrative is marketing. It serves industry profit motives, not your financial health. Now, here's the part that should make you furious. While you've been running this impossible race, someone else has been watching their wealth double simply because they started with family money. Those with family wealth or inheritance clear the down payment barrier easily. Those without run the race I just showed you. The race where the finish line moves faster than you can run, and each year you wait costs you. Rents increase, home prices increase, the gap widens. Someone who bought in 2015 with family help for the down payment now has $200,000 plus in equity from appreciation alone. They didn't earn it. They didn't save harder. They didn't make better choices. They just had parents who could write a check. Someone who spent those same years saving still doesn't have enough for today's down payment because the target moved. This isn't meritocracy. This is dynasty preservation. The brutal truth is the system is designed this way intentionally. Housing policy that requires substantial down payments ensures existing homeowners see their wealth appreciate while preventing new entrants without family wealth from building equity. It's a transfer mechanism. Wealth flows from renters to landlords, from PMI payers to insurance companies, from high-ratio borrowers to lenders collecting interest. And the barrier to entry keeps rising to ensure the transfer continues. Every politician who talks about homeownership as the path to middle-class stability while doing nothing about down payment barriers is protecting this system. Every financial advisor who tells you to buy as soon as possible is either ignorant of the complete math or benefiting from the transaction. Every parent who tells you they bought their first house at your age is forgetting their house cost 3 times their annual income while yours costs 6 times yours. The comparison is meaningless. But let's address the elephant in the room. The costs both paths ignore. Start with opportunity cost of the down payment itself. $100,000 invested in index funds at 10% annual return becomes $259,000 in 10 years. That same money used as a down payment generates equity only from the tiny principal paydown in early years plus appreciation minus all your carrying costs. In the first 10 years of a mortgage, you're paying mostly interest. Your equity buildup is minimal. Then there's the tax deduction myth. Everyone says you get to deduct mortgage interest. At $95,000 income, the standard deduction is likely better than itemizing. The mortgage interest deduction primarily benefits high earners with expensive homes and high marginal tax rates. It's regressive policy disguised as middle-class support. Most first-time buyers get zero tax benefit from their mortgage. Now add the mobility trap. Selling a house costs 8 to 10% between agent commissions and closing costs. On a $500,000 home, that's $40,000 to $50,000 just to exit. If you need to move for a job opportunity in year 3, you've likely lost money even if the home appreciated. You're trapped by the transaction costs. The career opportunity that could increase your income by 30% requires you to sell at a loss or become an accidental landlord. And finally, the life cost that never appears in any calculator. Years of delayed family planning because you can't afford childcare when you're house poor. Career risks not taken because you can't survive 3 months without income. Businesses not started because every dollar is spoken for. Relationships strained by constant financial stress. Health deteriorating because you can't afford the copay, or the gym membership or the therapy you need. All because you're cash trapped in an asset you can't easily liquidate. Let me give you permission to do something radical. You can choose not to play this game. If the total monthly housing cost exceeds 35% of your gross income, you're being set up to fail. If gathering the down payment requires depleting your emergency fund, you're being set up to fail. If gathering the down payment requires raiding retirement accounts and paying penalties and taxes, you're being set up to fail. The lending industry will approve you. The real estate agent will congratulate you. And you'll be house poor by month 3. Renting isn't failure. Renting is protection from a system designed to trap you. Buying when you have 20% down from actual savings, not family gifts that create emotional obligation, means you're playing from strength. Buying with less than that means you're playing from desperation, and desperation leads to bad financial decisions that echo for decades. You are allowed to wait. You are allowed to rent forever. You are allowed to move to a lower-cost market where the math actually works. You are allowed to reject the narrative that homeownership equals adulthood or success. The real financial maturity is recognizing a bad deal and walking away, even when everyone around you is signing papers and posting house keys on Instagram. Building wealth through retirement accounts and taxable investments while renting can outperform homeownership mathematically. It definitely outperforms being house poor. You're not losing the race. You're choosing not to run a rigged game. Your worth isn't measured by whether you own property. Your financial future might actually be brighter if you never do. The American dream narrative of homeownership serves industry profit, not your well-being. We've normalized house poverty. We've rebranded financial struggle as adulting. We've turned the inability to take a vacation or save for retirement into a humble brag about being a responsible homeowner. This is exploitation dressed up as achievement. Look at what your parents paid for their first house. 3 times their annual income was typical. Your house cost 6 times your income. They had pensions. You have a 401k you can't afford to fund. They had stable employment with raises that matched inflation. You have gig economy uncertainty and wage stagnation. Their advice doesn't apply. Their experience isn't replicable. The game changed and not in your favor. You have permission to opt out entirely. Choosing not to participate in a rigged system isn't giving up. It's refusing to lose. Financial maturity means recognizing bad deals and walking away, even when the cultural pressure is immense, even when your parents don't understand, even when your friends are buying, even when you're the only one still renting at 35. Real wealth is freedom, not appearances. It's having 6 months' expenses in the bank. It's maxing your retirement accounts. It's being able to take the job opportunity across the country without selling at a loss. It's saying yes to your kid's field trip without doing mental math. It's not lying awake calculating whether you can afford the roof repair. That's wealth. Not granite countertops in a kitchen you're too stressed to cook in. The down payment requirement isn't a test of financial discipline. It's a generational wealth barrier designed to separate those who have family money from those who don't. And the PMI alternative isn't an escape hatch. It's a different cage. You can choose neither. You can build actual wealth while everyone else builds equity at the cost of their present life and future retirement. The system needs you to believe renting is failure. It needs you ashamed. It needs you desperate enough to sign papers that benefit everyone except you. What it doesn't need is you running the math, seeing the trap clearly, and walking away. That's why nobody shows you these complete calculations. That's why the narrative stays focused on the dream instead of the mathematics. Because the math reveals the truth, you're not failing. The game is rigged, and the smartest move might be not to play.